Today, crypto markets rallied despite a slowing U.S. economy. Tech giant Meta reported earnings, and its metaverse is losing billions. And Dan Morehead of Pantera talks about what's next for DeFi after the crypto downturn. Welcome to CNBC's Crypto World. I'm Kate Rooney. Investors are shrugging off rising interest rates and digital assets are rallying. By noon Eastern, Bitcoin traded at $23,000. Ether, meanwhile, soared to $1,700, and Solana traded above $40. Today's rally is also happening in the face of new economic data that showed U.S. GDP declined for a second quarter in a row. Many economists see that as a sign that the U.S. economy has fallen into a recession. For much of this year, crypto investors were concerned about Fed policy and a possible recession, but now crypto investors could be turning their attention back to regulation.
Regulatory landscape is shaping up to be quite well. Most countries are adopting regulatory frameworks. They're not banning Bitcoin or cryptocurrencies. The macroeconomic situations, there's going to be high inflation. Let's talk about recessions, etc. All of those things drive adoption into Bitcoin or into crypto.
Okay, on to the top stories. First, Facebook parent company Meta reported earnings yesterday, and its metaverse business is bleeding cash. The company reported that the Meta Reality Labs unit, which is responsible for developing its metaverse, brought in $450 million in sales, but lost $2.8 billion overall. Things don't look much better next quarter either. Meta expects that unit to bring in even less money in Q3. It also raised the price of its Quest 2 VR headset by $100 thanks to rising production costs. Oh, and then there's the new lawsuit filed by the FTC to stop Meta's acquisition of VR fitness app Supernatural. In a filing, the FTC says it wants to stop Meta from owning, quote, the entire metaverse. As for the business overall, well, the tech giant reported its first decline in revenue ever and expects it to fall again in Q3. Next, Thai crypto exchange ZipMex just filed for bankruptcy. The filing comes a week after the company halted withdrawals due to, quote, a combination of circumstances that were out of its control. Coinbase had been in talks to acquire the exchange earlier this year, but the deal collapsed, and instead it made a strategic investment in that business. Just this week, ZipMex announced on Twitter that it was in talks with, quote, interested parties looking to either invest or acquire the company. Last up, the Federal Reserve is still looking into making its own digital dollar, but it doesn't seem to be a popular idea. The Cato Institute analyzed more than 2,000 responses to the Fed's request for public comment on that initiative and found that 66% of respondents view a digital dollar negatively. Cato found that respondents were mostly worried about privacy and risks to the economy associated with removing banks as intermediaries. Also important to note, the think tank itself is against the idea of a CBDC and says it is a risk to financial freedom. Okay, for our main story of the day, I spoke to Dan Morehead, CEO of Pantera Capital. This month, Pantera released a defense of DeFi, saying it worked flawlessly in the crypto downturn while centralized finance failed. I asked Dan about that report and a whole lot more. So let's start with what's gone on with recent liquidations and all of the credit issues we've talked about. Are we through the woods on that in terms of the crypto market?
Yeah, I think we're really close to the end. That in any leverage situation, and particularly with DeFi smart contracts, things do get liquidated pretty quickly. And the market's actually been going down for 8 months. You know, the high was in November. So whatever stresses we were going to see in the system, they basically peaked in May and June. We already have companies that are in bankruptcy court liquidating. So it feels like we've kind of seen all that we have to, and that the markets can kind of start trading on fundamentals again.
And you've argued that DeFi platforms actually held up pretty well in the face of everything that happened. And the problem really was centralized companies. What do you mean by that? Can you expand on that a bit?
There's a lot of skeptics on blockchain, and many of them are promoting the view that DeFi failed. And that really isn't true. There's certainly some failures in the blockchain ecosystem, but almost all of them are centralized lending counterparties, which, really are essentially banks. Some of these entities operated just like banks, took in short-term deposits, lent long, and then you had an old-fashioned run on the bank. People wanted their cash now, and they were invested in things that didn't have liquidity. And so it really is essentially the centralized lending companies that failed, and almost all the DeFi protocols did very well. And it is actually fascinating that a lot of the failed centralized banking entities were doing business with DeFi, and the smart contracts essentially forced them to perform to get their collateral back, whereas the centralized companies didn't perform to their customers.
When you're talking about DeFi and sort of forcing that to happen, forcing performance, is that the sense that it would force a liquidation sooner than you might see in traditional finance?
It does, and that's the beauty of DeFi. It's just code. People agree up front what the terms are, how much collateral they have to post, at what level they're going to have to post more collateral, what will happen if they don't post more collateral. So all that's literally codified, and so it just happens. It happens automatically. Whereas, if any bank, normal banking like Lehman Brothers or these new crypto banks that have struggled, it's all a lot more opaque. It's based on, kind of vague assurances of what will happen when things go wrong. And so, sometimes, they suspend withdrawals. Sometimes they, don't pay debts back on time, all those things. Whereas DeFi can't do that. It just actually executes the code.
So the code worked here, but can this ecosystem work without these centralized companies? Is it realistic to think that DeFi could operate without any of these other centralized companies, hedge funds, lenders? What's going to happen to those guys?
Yeah, so there's definitely a place for both. There will be new versions of centralized lending protocols, companies in blockchain that are successful, and some were successful throughout this, right? So those will still be there. But DeFi doesn't need those centralized entities. It's just matching a borrower and a lender, or it's matching somebody who wants to sell something with somebody who wants to buy something. And that is a very powerful new idea. And I actually think it's staggeringly cheap right now because the markets have come off so much, and there's so much kind of bad kind of misinformation. Basically, the entire market cap of all DeFi tokens is about 20 billion right now. That is less than 0.5% of the value of the centralized finance companies. That's really cheap, and obviously there will be centralized finance companies in the future, and it's not going to completely take over the banking system and things like that. But at less than 0.5% of all those companies, DeFi is very cheap at the moment.
And there have seemed to be a lot of these DeFi companies have popped up, or protocols you would call them, in the last few years. Are there examples that didn't work, or do you think won't work in the future? And how much space is there in that entire ecosystem for a bunch of winners? How do you sort of assess who will be the best of the DeFi protocols, or at least sort of the top tier?
Yeah, so there is one exception to the statement that DeFi worked great. Terra Luna had a lending protocol that was all kind of associated with it called Anchor, and that failed when everything kind of in the whole Terra Luna ecosystem failed. But I would say that's much more specific to a single type of algorithmic stablecoin didn't work. And it doesn't really have anything to do with, the blockchain concept in general. And so everything else did work, Aave, Compound Maker, all those protocols work flawlessly. And so, when the dust clears and everyone is thinking about the level head, people will start piling back into DeFi.
So as an average investor, though, so if you're looking at a project, 6 months ago, say you were looking at Terra Luna, in a lot of ways, it looked the same as some of these other decentralized finance protocols. How can the average investor do their diligence and know, which of these is going to hold up in a crisis, or is that just a risk you're taking by investing here?
Oh, it is. And I think the very important point is to always buy a diversified portfolio of ideas, right? This is a very disruptive new space. There's going to be lots of experiments. Some are going to work great, some are not. And it's just like the .com era and the internet. We tried a whole bunch of ideas. Some worked, and the companies we all know and love today, and a lot just didn't work. And so that's what you should think about DeFi or all blockchain is it's very speculative, early stage investing. And so certainly don't put all your eggs in one basket. Invest in a bunch of different things, and the average will do well.
And what about the yield that was being offered along with some of these DeFi protocols? Even if the code was its own thing, there were also these layers that were offering what seemed to be unsustainable yields. Have those completely gone away? It seems like there's still examples out there where you can get 20, 30% yield. It hasn't been totally fleshed out. What's the future of sort of this yield farming in DeFi?
Yeah, so I'll make a point that most of those ludicrous yields were being offered by centralized lending companies like Celsius or BlockFi or whatever. And so there were very few examples, Anchor being one, that was a DeFi protocol that did offer yields that now we know are unsustainable, that they couldn't exist. And the way to think about it is those higher yields are either because there's just this massive supply and demand imbalance, or maybe because there is a lot of risk and it isn't risk-free, or maybe there's a potential, risk in the code. And so in hindsight, we now know that, there was a lot of risk in some of these DeFi protocols.
Okay, that's all for Crypto World today, but we'll be back again tomorrow with a lot more. We'll see you then.